All right, guys, today we're going to look at various types of financial institutions and basically how they get involved with businesses. Um, there's a list of the main participants in the financial markets. There's some obvious ones that you would be aware of. Banks, investment banks are banks like Macquarie. They're more interested, rather than in dealing with day-to-day transactions of customers, setting up basically large deals where people are shifting millions of dollars around and taking brokerage fees from that. Although, interesting enough, Macquarie Bank's now branched out into bog standard household mortgages. Insurance companies, basically the way the banking system works is that when you invest money into the bank or put it in your bank account, they pull it all together and then lend it out to other people at an interest rate. The difference between what they charge their customers' interest and what they pay you for your investment is how they make their money. When you're talking billions and billions of dollars, a 1% difference per year is a phenomenal amount of money. They'll often charge up to 3 or 4%. Superannuation funds, one of the great things that the Labor government of the 1980s did was make superannuation compulsory. This has meant a vast pool of money around Australia that's ready to be invested to help grow the economy. It's made a huge difference to basically people's well-being and livelihoods over the last 30 years. And various other things like unit trust and companies designed around investing money in the Australian Securities Exchange or the Stock Exchange. So going through in detail, banks, obviously the most common type financial institution. They take the money from depositors and then loan it out. Investment banks, basically it's more about the financial services and large deals. They don't deal with day-to-day banking accounts generally. And finance and life insurance companies, basically when you invest your premiums and insurance, again, they pull that money in together and then loan it out, basically making profits on it, and the expectation that they're not going to have to actually pay you out your insurance. As long as they have a wide enough number of people who are buying insurance, they only have to pay about a small amount. But they also then on-sell insurance to other companies to guarantee their losses. For example, when you have the Black Summer fires, insurance companies taking a huge hit there, they've actually insured against those losses with other companies overseas to basically just spread the risk. Superannuation funds, as I say, 9.5% currently, soon to be up to 10% of wages, and it's not actually out of your wages, it's additional what your employers actually pay you, a deposit into superannuation funds, and it's a massive pool of capital. In your jobs, make sure that you are being paid super, because the sooner you start investing these into decent super funds, and ideally you want a single super fund, not whatever your employer sets up, so when you change jobs, you keep getting money into that single pool. Make sure you manage it super actively. Don't just let it sit there and gather dust. And unit trust is basically where a number of investors pull together and then invest them in businesses. And obviously we talked about the stock exchange.